I'm going to talk about the Fed and how it's set up. So, if you remember correctly, the Federal Reserve is the lender of last resort. It's also called the banker's bank. And it also acts as, it carries out monetary policy, and it's also a regulatory institution for banks. So the Fed has a bunch of different hats that it wears, and it's divided up. You don't need to know a ton of the specifics, but I'm really going to try to cover the stuff that I've seen on past AP tests. So I want to first kind of draw out the structure of the Federal Reserve to just kind of show you what it basically looks like and who's the head of what. So on the top here, you have the Board of Governors. All right, you have the Board of Governors on the top. And so the Board of Governors, there are 7 members of the Board of Governors. And they're appointed by the President and confirmed by the Senate. The head of the Board of Governors is the chairman of the Federal Reserve. In this case, it's chairwoman of the Federal Reserve currently.
Wait, so the head of the board?
The head of the Board of Governors is the chairman of the Federal Reserve. I would argue that, in this case, she is the second most powerful person in the world, simply because she controls the entire money supply of the United States, as well as she doesn't control it, but her words and her actions, just even her words and sometimes even her inactions, can spark rallies on Wall Street and get the economy humming, or can really decimate the economy and essentially kind of crush any rally that's happening. There was I don't remember when it was, but it was a few years back, and it was a different Fed chair. But that Fed chair had a cold the day that he was supposed to speak, and the markets went way down because there was insecurity, instability at the Federal Reserve, even though this guy just simply had a cold. So they're incredibly powerful. When they speak, people listen. The chairman of the Federal Reserve, when she speaks, things stop and everybody kind of listens to what she has to say. She talks about the health of the economy, how they see it, the Federal Reserve sees it, as well as any kind of monetary policy they may pursue in the future. And so people really kind of pay attention to that. Because remember that they're going to control the money supply and also interest rates. So that has a ripple effect from basic credit cards to the housing market, the business market, and all types of stuff. So the chairperson's incredibly powerful. On the Board of Governors, they serve a single 14-year term, and they cannot be removed. The idea behind this is more of an AP question. Why can the person not be removed? The idea behind it is that they're politically insulated, and so they don't have to worry about getting elected or reelected. And so they can do things that aren't popular at the time. So if they decide, and they are currently trying to decide when are they going to start to tick up interest rates, that's not necessarily a very popular thing to do. Right? Because ticking up interest rates means they're going to slow down spending, and there are going to be a lot of industries and secondary and tertiary industries that are hurt by this. It's not just the housing market that gets hurt by them increasing interest rates on housing loans. It's also carpenters and lumber yards and realtors and furniture makers, and I mean, just imagine all the people that kind of go into appliance makers, all the people that go into making a house functional. And so they also are negatively affected. And so you kind of get that ripple effect through the economy. But they also, remember, they're dual mandated. They care about inflation. They also care about unemployment. And so they may have to do things that aren't necessarily popular to make sure that they're meeting the requirements that they're trying to meet. All right, so the Board of Governors. If a chairman gets picked out of the Board of Governors, which sometimes happens, they still just have 14 years. So the current Fed chief, bless you, she was part of the Board of Governors before. A guy by the name of Ben Bernanke was the head chairman of the Fed. She got picked, but a lot of her 14-year term was already up. And so now President Trump gets to decide on a new chairman. And so he may pick somebody from the Board of Governors. There are 2 people that he's considering directly from the Board of Governors, but he's also met with an economist that teaches at Stanford, I believe, and another economist that's on his Board of Advisors. If he picks that person's in for 14 years. So there's, as you can imagine, that's a pretty big pick, and so a lot of people are watching to see what he does.
Can they like turn it down?
They can say no. Yeah, they can say no for sure.
They're not like gonna force it.
All right, so the Board of Governors is, you can't say no. And the Senate can refuse to confirm the person too. So underneath the Board of Governors, which is probably the most powerful of the Federal Reserve, is the FOMC, the Federal Open Market Committee. And I'll talk specifically about what they do. So all 7 Board of Governor members are on the FOMC. Then there are also additional members that come from the district banks, or the Federal Reserve, the other Federal Reserve banks. And so they're district banks, and those districts are, so here are the district banks. So those district banks have presidents. And so there's a district bank in Kansas City, that's the one that Colorado is technically a part of. Then there's one in St. Louis, so Missouri almost gets 2. There's one in Virginia, there's one in New York, there's one in California. They're kind of spread out geographically. Now, the Federal Reserve didn't always exist since the onset of the United States. Those of you that listen to Hamilton or took APUSH know about all of the going back and forth about a Bank of the United States, and it happens, and it's found unconstitutional. Happens again, it's found unconstitutional again. The Federal Reserve is not really a Bank of the United States, but the idea behind it kind of is. So the Federal Reserve Act of 1919 creates the Federal Reserve. So it's Wilson. All right, he creates the Federal Reserve. The idea is to even out all these like panics and rushes and these boom periods, to kind of even it out a little bit more. And so their kind of big test is the Great Depression. It's the first big test of the Federal Reserve. Whoopsie, they kind of messed that up. So anyways, these boards were spread out. If you can imagine, 1919, most of the U.S. population lived east of the Mississippi. So I think 10 of the 12 Federal Reserve banks are located east of the Mississippi. And like I said, the only one that I think is the only 2 is, but there's one in Dallas. So I think 9 out of the 12 are located there. So, so they're kind of spread out, and they have presidents of all these banks. On the FOMC, the guy that's the president of the New York branch is always on the FOMC. So you have the 7 governors, the president of the New York Bank, and then they have 4 rotating members. So there are 12 district banks. So of the 12 of the district banks, there are 12 of them. So they have included is the New York Fed, the head of the New York Fed, and then there are 11 other district banks. So on the FOMC, the New York Fed, all the Board of Governors, and then 4 rotating members. Yeah.
By rotating, do you mean like yearly or like every?
Yeah, I think they're yearly. They're either yearly or bi-yearly. So yeah, they rotate on and off.
So
now all of them are there, but only 4 of them, plus the New York guy gets to vote, and the Board of Governors. Yeah.
So the Board of Governors and 4 of the people from district banks.
Yeah, including always the guy that's the president of the New York Fed is always on it.
Cool.
That guy doesn't rotate, or girl. That's been a guy for as long as I can remember. So they rotate. Now, why am I giving so much time to the FOMC? They're the ones that decide monetary policy. They decide to up interest rates through manipulation of the money supply, which we're going to talk about for you guys on Wednesday, Thursday, and Friday of this week. We're going to really kind of concentrate on that. But they get to decide interest rates, money supply, and so they're extremely powerful. And they're going to do this through buying and selling bonds, which again we're going to talk about here this week. So they're incredibly powerful because they decide monetary policy. So when Janet Yellen says, we think the economy is pretty healthy, we're going to start upping interest rates, they get to vote on it. The FOMC gets to vote on that. So extremely powerful. The district banks, all 12 of the district banks, they kind of have two purposes. One, they carry out whatever the FOMC decides. So if the FOMC decides to buy bonds, that means they're injecting money into the economy, and again, we'll talk about that. But as they're doing that, as they're injecting money into the economy, again, they don't sit in a helicopter and just dump bags of money. That'd be a lot of fun. And it'd be like Hunger Games, like real style. But they don't do it that way. Instead, they buy bonds from banks. Banks use that then money that they have to then loan out to consumers. That's how money gets put through, and then you guys have the money multiplier and all that kind of stuff. So the district banks are in charge of buying and selling bonds from banks. So they carry out monetary policy. They also, as you can imagine, different areas geographically in the United States have different needs economically, and so they invite business leaders and people to come and talk to them about how things are doing in those districts. So as you can imagine, in the Midwest, it's going to be a lot of farming and ranching and things of that nature. In the Northeast, like where New York is located, that's going to be a lot of trade and merchant type things. In the South, they're going to have different needs, and on the West Coast, they're going to have different needs. So again, these Fed presidents also speak into that when they talk about the FOMC, because what might be good for the Northeast may not be good for the Midwest. And so they've got to try to balance that. Underneath them are commercial banks. So they also act as regulatory bodies to commercial banks. And those commercial banks are the banks that you and I go to. The banks like Wells Fargo or First Bank or Bank of America, they regulate them. They oversee them, and so they're the ones that'll go in and say, you're supposed to be keeping 10% of your deposits on hand. Do you have those? And again, that money's not in a vault. It's usually through a computer, or they can actually store it at the Fed, so the regulator doesn't really have to go many places. They also do stress tests on the banks, like there's a bank run, how are you going to handle it? Like what assets are you going to pull from and stuff like that. So they do stuff like that. They're the regulatory body of any commercial bank that you go to. They also sort of regulate what we call thrift institutions. They've got $20 in their pockets. They're going to pop some tags on the thrift institutions. That's not how that works. A thrift institution is like a credit union. And the reason why the line's dotted is they sort of oversee them. Remember, the only people that can order up new money and distribute it is the Federal Reserve. If you decide you're going to distribute new money, you're putting it in your basement, the Secret Service is going to have a few questions for you. You're probably going to get in a lot of trouble. So they sort of oversee them, but they're actually thrift institutions, like credit unions, are actually overseen and regulated by a different body. But ultimately, they do fall under the responsibility of the Federal Reserve. And then those commercial banks and thrift institutions then go down to the individuals or households. So again, you go to Wells. I just had a situation like this last week, the Friday before last. I deposited a big check into my bank account, not because I started selling drugs or got a huge pay raise, but because we're refinancing our house and I got a huge check back and I needed that money to help refinance my house. And so I deposited on Friday, there was a hold on it. So I went into my bank and said, hey, I need that hold removed. That account that it came from has money in it. You can see that by computers. Pretty easy to see that you actually possess that money in that account. I need the hold removed, and they said, well, we can do that, but we can't do it until Tuesday. I'm like, that's a random day. Why not? Well, that last Monday, like a week ago today, anybody know what was special about last Monday? Columbus Day. Yeah. So. The bank was open, but the Federal Reserve was closed. The Federal Reserve acts, I think I've told you guys, acts as the banker's bank. If the bank is short on cash, okay, it doesn't hold just cash in its vault. If the bank is short on cash, they can go to the Federal Reserve for a short-term loan. And they can get that cash given to them, and then when loan payments come back to them, then they essentially pay the Federal Reserve back. they couldn't get that cash until they collected through the Fed, the Kansas City Fed. They couldn't get the cash so I had to wait until Tuesday because they couldn't collect it from the Federal Reserve. So the Federal Reserve not only oversees all monetary policy, it also acts as a lender of last resort to banks as well. Again, even though for me it was a ton of money that I needed, for a bank like the size of Wells Fargo or First Bank or any commercial bank you go to, that's a piddly little amount of money. But the thing is that the Federal Reserve is also kind of the collection agency. And so the little like numbers, if you've ever seen a check, some of you may not have never actually seen one. And I'm gonna come to a point in my teaching career. If I teach as long as Frage, you're gonna be like, remember when there were cars? Because he's 10,000 years old. But you know, checks are getting rarer and rarer. But at the bottom of your check, there's a whole bunch of numbers on the bottom of it. One of those numbers is actually the branch of the Federal Reserve that's responsible for collecting funds and then distributing to the bank. So if you, again, I'm going to show Catch Me If You Can in class, not in class, during one of the business lunches. And if you watch Catch Me If You Can, Tom Hanks explains it very quickly, but he does explain it. And so the Federal Reserve branches kind of act as a collection agency for all the other banks. Yeah.
Okay, so why is it with banks today that it's so hard to close an account? Like, they make it super
Yeah,
hard.
that was a joke on Friends. So why is it so hard to close an account? Because they don't like to lose your business. Remember, if you take your money and you go from bank A over to bank B, what does bank B do with your checkable or your demand deposits? They loan them out, yeah. So they don't like you to close accounts because that means you're taking your money out of their bank, which they're loaning, goes that money out, and you're not putting it into your money.
Just makes it hard for kids.
Yeah. So there's a friend, so they actually make fun of that, and they're like, I want to quit the bank because they want to quit the gym, and they find out that actually closing a checking account is harder than quitting the gym. So it's a real funny friend. I forgot what episode it is, but it's really funny because they try to close all these accounts and stuff, and it doesn't work. So that's the basic kind of structure of the Federal Reserve. So you guys are now going to have time to work on econ lowdowns.